Okay, so this is the next video on how I am trying to turn $5,000 into a lot more money using my problem-solving skills in physics and math. So first area I'm going to start is investing in the stock market. Okay, so here are 5 options I've come up with. Purchase individual stocks on margin. So figure out the characteristics of stocks which recently returned more than 200% in 1 year. 2, purchase the S&P 500 index. 3, purchase the S&P 500 index on leverage. 4, options trading. And 5, day trading. Okay, conclusions from what I've come up with so far. 1, the stocks which show the greatest returns are the most risky. So herein I showed that the stocks that provided in excess of 200% return the past 1 year were losing money and were very small. Recall Amazon and many other great companies lost money for many years after they started their business. 2, the best long-term investment solution is to invest in a large portfolio of diversified stocks. This can be proven mathematically because returns of individual stocks average, but the risk of the portfolio drops as you add companies to the portfolio. The S&P 500 returned 10% per year for the past 20 years, and only 1 in 10 professionals can beat the S&P 500. But I need far more than this, so I will invest in it using leveraged S&P 500 minis. This gives you 50 to 1 leverage. So 1 point in the S&P 500 index is 50 points in the contract. What about patterns in pricing data using tools like VWAP, MACD, RSI, and Bollinger Bands? This is some of the stuff that day traders use. This is easy. Absolutely not. The vast majority of day traders are not making money. These tools are not bad to use as a timing mechanism of once you've made a decision to buy or sell a stock, when to actually execute that trade. Here's an example of a company that lost money for many, many years prior to making money, and that's Amazon. Okay, and yet in these earlier years when they were losing tons of money, their stock was doing really well. And you're going to see quite a few companies coming up here in a minute that are losing money, but their stocks are doing quite well. Okay, so this is my Ameritrade account, and I'm doing some screens here. So what I'm screening for are NASDAQ stocks that have a pretty low price, so we can get the maximum leverage. They returned more than 200% on their price in the last year. Okay, 30 such stocks exist. Okay, and then I said, well, what about just small companies? Okay. It went from 30 to 21 matches. So 2/3 of the companies on the NASDAQ, which returned 200% or more in stock price, were very small companies. Then I added, what about companies that are losing money? Okay. So now it went from 21 to 17. So the vast majority of companies that returned 200% or more on their stock, 17 out of 21 were losing money. Now, what's my universe of small companies with a very low price today that are losing money? Well, that's 1,355. Okay, in conclusion, from those filters you just saw, 2/3 of companies that gain 200% or more in stock price in the past year are small companies. Small company defined as 50 million to 2 billion. That's the value of their stock. The total was 21 companies from a universe of 2618. Of these 21 companies, 17 were losing money on an earnings basis. So the universe of small companies which lost money was 1,355. Thus, 17 out of 1,355, or 1.2% of my universe, gained in price by more than 200%. So if one were to randomly pick a small company that is losing money from the universe of 1,355, he would have a 1.2% chance of increasing his investment by over 200%. But this is a very risky group. So of that universe of 1,355, over the past year, 75% of the prices went down and only 25% went up. 9 of those 1,355 lost 100%. And again, 17 of the 1,355 gained 200% or more. The rest of this video provides some details about some of the companies in this group. The next video, I will show you how to leverage the market using S&P 500 mini futures, which enable you to earn 50 times the market. Of course, after forward delivery, which pays the provider for the cost of the hedge, the return is not 50 times. The scenario I ran was a 4% increase in the market, provided a 40% increase in the 500 mini futures investor. This is still a great multiple, 10 times, great leverage. Okay, so let's take a look at these. Let's look at this company, Applied Digital. Okay, it went up 589%. Wow. All right. Okay, so what are we looking for? Earnings per share negative, so they lost money. The market cap, that is the market value of all the stock that is trading, 722 million. So that's considered a very small company. Let's look at a couple of key metrics. One is debt. You want debt to be less than 60% or so. It's 25%, so that's pretty good. Another important metric I look at is cash flow. Right? Are they generating cash from operations? And while they're losing on an earnings basis, but earnings is not the same as cash. I think cash is more important. But this tells us right here that they're losing cash every year. Okay, it's getting better though. In 2007, they lost about 2.5 million in cash. This past year, they only lost about let's see, this is in thousands, so 500,000 in cash. So they're losing cash at less of a rate. Okay, let's look at another company. How about this one, Muscle Maker? Okay, Muscle Maker went up 200% in the last year. Okay, so this company shows no EPS, earnings per share, so that means it's probably negative. And they have a market cap of 38.1 million. Okay, a pretty small amount of debt, only 5%. A very good quick ratio. That's the ratio of current assets to current liabilities. It's a measure of liquidity. They're also losing cash from operations. Okay, so this is also in thousands. So in 2021, they lost about 6 million in cash. So another company that is losing money. Let's take a look at this one, EOS Energy Enterprise, and that's they gained 200% last year. Okay, so they're losing money also, minus $3.70 per share. They're also a very small company, 623.2 million in market cap. Okay, they have an enormous amount of debt, 600%. The liquidity ratio is not good at 0.55. It should be 1 or above. And they're also losing a lot of cash from operations, so 200,000, and this is in thousands. So they're losing $200 million a year in cash. Another company that financially is in awful shape. Okay, let's take a look at one more. Again, I'm just randomly picking these. Here's an interesting one. This was up 227%. Pulse Biosciences. Okay, so what is Pulse Bioscience up to? They lost money, $1.41 a share. Also a very small company, $307 million market cap. Their debt ratio is also extremely high. This should be less than 60%. It's extremely high. They don't have a measure for the quick ratio. That's not a good sign. And they are also losing a lot of cash from operations. So $40 million they lost in 2022. So once again, the characteristics of companies whose stock price rose more than 200% over the past year were financially in miserable shape. And here's just a summary again of some of these statistics I just showed you. So stay tuned for the next video where I'll figure out which one of these stocks in my universe of 1,300 or so stocks I'm going to invest in to try to earn some large returns.